Hi, and welcome to Tax Tips for Medical Professionals. My name is Jessica Chisholm, and I'm from Huddleston Tax CPAs. The things I want to talk about today are entity selection for your business, the auto deduction and how that's calculated, what qualifies as a home office and how to take that deduction, equipment, buying versus leasing, hiring family members into your business, deferring payroll taxes on owners, and then other miscellaneous deductions to remember. First thing you do when you start your business is you want to make sure you select the correct entity. You can change the entity as time goes on, but it's really best to consider the type of entity you want to be from the beginning to start it off the way you'd like to continue. The choices for entities are sole proprietorships, LLCs, partnerships, C corporations, and S corporations. Sole proprietorships are the easiest to set up. Just get a business license with your state and you're ready to go. However, you do pay self-employment tax on 15.3% of the profits. LLCs are disregarded entities for tax purposes, so you can be taxed as a sole proprietorship, partnership, or elect to be taxed as an S corporation. Single-member LLCs are taxed as sole proprietorships, just Schedule C on your 1040. Multi-member LLCs are taxed as partnerships, but both can elect to be taxed as S corporations with the IRS. And we'll talk about S corporations in a minute. Partnerships are when you have two or more owners sharing in the profits and losses. Partnerships are pass-through entities, so there's no tax at the partnership level. Each partner receives a K-1 with their share of the income that is then taxed on their 1040. Net income for active partners in a partnership is also subject to that 15.3% of self-employment tax. C corporations are what people talk about when they're talking about double taxation of corporations. You pay tax at the corporate level and then again on any dividends that are distributed to the owners or shareholders. You can also pay yourself a salary out of the C corporation, but that again is taxable on your 1040. S corporations are flow-through entities like partnerships, so there's no tax at the corporate level, so you avoid that double taxation, and you can potentially also save on self-employment tax. S corporation owners are required to pay themselves a reasonable wage. After that reasonable wage, whatever's left in net profit can be distributed out to owners as distributions. These distributions are subject to ordinary income tax on their 1040, but not subject to that self-employment tax. So that's where you can save that 15.3% of self-employment tax. If you want more details about how S corporations can save you money, please go to smallbusinesswebcast.com and attend the webcast by John Huddleston called LLCs and S Corps Explained, using them to reduce taxes. Also new for 2018 is the 20% pass-through deduction for pass-through businesses. This will be for sole proprietorships, partnerships, and S corporations. Basically, 20% of the net income will be a deduction on page 2 of your 1040. There are income limitations as well as industry limitations, so you will want to contact a tax professional to see how you would best qualify for that 20% pass-through deduction. The auto deduction is important for business owners who are driving around to meet clients or to get things like office supplies or to go to the post office. You want to track your business mileage as well as your total mileage for the year. And there's two ways to deduct it. Standard mileage deduction or the actual expense method. For the standard mileage deduction for 2018, you just take your business miles and multiply by 54.5 cents per mile to get your deduction. So again, business miles would include trips to the post office, to buy office supplies, to meet with clients, go to the bank, etc. Business miles do not include trips from your home to your office, unless your office is in your home, in which case every time you leave your home for business, it would be deductible. However, there's not a lot of medical professionals that meet in their home. The actual expense method is when you deduct the business portion of the actual expenses used to operate your vehicle. So you would track all expenses as well as the mileage. You still need to track the business and total mileage, but you also would track gas, repairs, oil change, loan interest, tires, license, anything it costs to maintain your vehicle. And then you would take and apply the business percentage to the total expenses, and that's what you would deduct. With the actual expense method, you also get to deduct the depreciation on your car. So if you change cars quite often, that you use for business, then it might be best to use the actual expense method because you're also getting that depreciation write-off. One thing to note is that you cannot switch back to the standard mileage once the actual is used. So you definitely want to work with a tax professional to figure out which is most advantageous for your business. So when it comes to buying equipment, or getting new equipment, you can choose to buy or lease that equipment. Lease expense is deductible as it's incurred. Purchased equipment must be depreciated over its useful life. If you're able to take that Section 179 on the purchased equipment, then you're able to recover most, if not all, of the cost in the year of purchase. Office equipment and furniture also count for that Section 179 deduction. And equipment does not have to be paid for in full to take Section 179. So you can finance the equipment and still write it off in the year of purchase. You're also then able to deduct the interest on the financing. And then starting in 2018, bonus depreciation has been up to allow 100% of new and used qualifying assets. So that's something else you can take advantage of when purchasing the equipment. And most assets with a depreciable life of less than 20 years will qualify for that bonus depreciation. So again, if you lease something, then you write off the lease expense as you incur it. So if the lease cost is $4,000 a year, that's what you paid out, that's what you deduct. If the equipment would have cost you $50,000, then you would write it off over the life of the lease. If you had purchased it for $50,000, you could potentially write off the entire $50,000 in the year of purchase. Next, I want to talk about the home office deduction. Most medical professionals, again, don't work out of their home office, but there are ways to still get your office to qualify for the deduction potentially. So a home office must meet one of the following requirements. It must be your principal place of business, or where you meet clients, or an office that's a separate structure not attached to your house, or where you store inventory. So if you do a significant amount of your administrative work at home, then that could qualify. If you store your business inventory in your garage, that could qualify. So there are ways, if talk to your tax professional about whether or not you would qualify, but there are ways to qualify when you still have, the main office where you meet clients somewhere else. You calculate the deduction using the square footage method. So my example here is if you have a 2,500 square foot home and your home office is 500 square feet, then you take a 20% write-off. So you can deduct 20% of everything it costs to run your home: mortgage, interest, property taxes, insurance, utilities, landscaping, security system, repairs and maintenance, etc. If you use your garage to store inventory or a 100% work use vehicle, then you could potentially deduct that space as well. You may also elect to use the simplified method, which allows you to deduct $5 for every square foot of your home. However, this is capped at $1,500 a year, so it's important to compare the simplified method to the actual method to see which is more advantageous for you. So next I want to talk about hiring family members. So when you own your own business, you can employ your spouse or children in your medical practice and claim their wages as an expense. For both your spouse and your children, you need to make sure to keep excellent records of when they do work, what their position is, and make sure you pay them reasonable for what they do. So you don't want to pay your child $60 an hour to come in and empty trash. You want it to be reasonable for what they do. Paying your spouse may also allow them to contribute to a retirement plan in their own name, or allow them to get wage credit towards their Social Security if they don't otherwise work. If your child is under 18, and your business is not incorporated, then no payroll taxes need to be withheld on your child's wages. And also for kids, you can pay them up to $5,700 if this is their only job, and they will not pay any income tax. So it's a way to kind of distribute the income across the family and get a deduction for that. One tax planning thing to consider is deferring payroll taxes on owners. So corporate owners who are also employees, so this would apply to C Corp and S Corp owners, can defer some of their payroll tax obligations on their income until the following year. So if you're trying to maximize your income in the current year and minimize it in the future year, you can pay the owner a large percentage of their salary at the end of the year, kind of like a bonus. And then the payroll taxes won't be due until the first of the next year. And on the cash basis, you don't deduct the payroll taxes until they're actually paid. So if you pay, say, a $100,000 bonus at the end of the year, and there's $20,000 or $15,000 of payroll tax due on that, that's not paid until the following year, then you would, you know, show your income as $15,000 higher for the current year. So this is if you're needing to maximize or minimize your income in current years. Some people ask, well, if I pay most of my salary at the end of the year, how am I supposed to get money to live the rest of the year? Well, cash flow needs can be met during the year using draws or loans to shareholders that then get zeroed out with that salary paid at the end of the year. And also tax withholding on the salary is treated as paid evenly throughout the year, so you don't need to make quarterly tax payments as long as you have sufficient federal withholding taken out of that year-end bonus. So just some miscellaneous deductions to remember. If your continuing education is deductible, your retirement contributions, you can contribute to a SEP, a simple 401k, and in any part that's paid by the employer is a deduction to the business. Like I talked about earlier, interest on any loans is deductible. Medical insurance for employees and potentially the owners, depending on how the business is structured, is deductible. And then there's meals and entertainment. This has changed slightly with the 2018 tax legislation. Entertainment is no longer deductible at all. It used to be deductible at 50%, but now that deduction has been eliminated entirely. Meals for travel continue to be deductible at 50%, and then meals for the convenience of the employer. So it used to be that if you ordered pizza for a staff meeting or had your annual Christmas holiday party, that meal was considered 100% deductible for the business. Under the new legislation, it is now only 50% deductible. So there are some changes to that. But you should still track it, the meals, and consult your tax professional about which are deductible. That's all I had today, but if you have any other questions, feel free to contact us at our contact information on this slide. And I hope you have a great rest of your day. Thank you for attending.